Hi all, my name is Aphindile Bokleni. I am from Vunani Private Clients. We're one of the stockbrokers in the JSE, and I sit in mainly the wealth management services. So I'm more client facing, I advise clients, I manage their portfolios, and I've been involved in developing a product that we have in mostly the retail space, low entry coming into the investment world. It's just a small startup trading account that uses ETFs as securities. I'll start with that, and I'll just talk about what is the difference between ETFs and shares, and which investor is usually suitable, whether to go for ETFs or for shares. It's quite a dynamic. It's quite a dynamic argument out in the market. It's a very, very big debate whether you should go full-on managed services where you pay an asset manager to actively manage your portfolio, or you should just buy the market, which is just buying passive product, which is ETFs. Which is better? We will get there at the end. ETFs are a security that's listed in an exchange. It can go through equity, bonds, it can be commodities, it can be the money market instrument. An ETF is just an index, it's an index tracker. So the sole purpose of an ETF is to track what the index is doing. So they always try to have a zero tracking rate of what the overall index is doing for that specific sector. Let me just dive into a few ETFs you'd find in the market. You'd find a Sectrix Indy, which is just an index that tracks the industrial companies in that particular sector. So what a Sectrix Indy will give you is what the industrial companies are doing. You will find the financial companies, which is the banks, the life assurers, general insurance companies, fund managers, are grouped in one index, and they move as a basket of shares, and that's what you're buying. So it can be a sector specific, so a portion of the sector, or you can just get the top 40, which is mostly like the overall market. You can get the overall market. And as I was saying, it goes through bonds, it goes through money market instruments, it goes through commodities. You're talking about gold, platinum, silver, palladium. You can get anything in the market through ETFs. When you're looking for ETFs, I would say look for the lowest TR, because that's the pricing, the asset manager, the guy behind managing, the bank behind an ETF, that's the guys who are managing the ETF. They will charge you a TER. It's usually around 19 basis points, depending on the instrument, to up to 1%. Some ETFs can be a bit expensive, but if you are looking for a top 40 ETF, look for the least expensive TER, because what it's doing, it's just tracking the index. So an ETF should have a zero tracking rate, so you're buying the market, so you must just buy the cheapest beta. Look for a cheap platform. That's just, I know most investors, I deal with a lot of investors, they're very cost conscious, so they want to get the best performance at the least risk and cost. And ETFs are quite good because platforms have gone down. It's very, very competitive industry. So you will, if you look around, you will get a very, very cheap platform. And to even go further, ETFs are usually mostly for, so you're buying beta because sometimes you do not want to pay a lot into an active manager. So you want to get the cheapest platform, you want to get the cheapest TR, because ETFs, that's one functionality of ETFs, is their cost. They are very low cost, so you want to keep it as low as possible. ETFs are usually good as well, because when it comes to the lower LSM level, so if you're not start investing, you're just new in coming into investments, you do not play around with your money a lot. You feel like investments are quite risky. You've heard stories before, so it caters for that market, that low capital requirements market. You can start with a debit order, because some people just want to come in with savings. So debit order 300 rands, it can go as low as 300 rands a month, or a lump sum of 2,000 rands. And some platforms I use, you can actually get 3 ETFs with 300 rands debit order, which is amazing because you can actually own the overall market. You can have a nicely diversified portfolio just through a 300 rands debit order and going upwards. Tips. I'd say first tip I would give to you is just to emphasize firstly on the costing. Look for a very, very cheap ETF. It can be an ETF or a unit trust. That's usually the same thing, because an ETF is a unit trust. It's a collective investment scheme, but it's just listed. So a top tip I'd give you is you can go the ETF route or you can go the unit trust route. Platforms fees usually change with that. So that's my tip. You wanna get the lowest fee because you're getting a passive product. Let's come to shares. Shares, you need a broker to actually open a stockbroking account. You will need professional advice, especially if you're a first-time investor. If you're new in the market, you just want to try it out, you will need professional advice because you can get into the wrong securities. You need to diversify your portfolio through a number of shares, which is the difference between where the difference comes with buying an ETF or buying shares. Is that with buying an ETF, you can buy a number of shares, 40 shares with one transaction, or you can go and open a trading account and start buying one share at a time. So ETFs comes at a much lower cost rate in a much less expensive way. So you want to also buy different sectors. So you do not want to be fully exposed on banks, because interest rates can go up and banks can come down, or something can happen in the industrial companies. So you want to be exposed in a number of sectors. So do not focus your whole investment portfolio on one sector. Try to diversify over a couple of sectors. Top tip as well here, it's really find out what type of investor are you. If you are quite a risk-adverse investor, so you're new in the market and you're just starting out, shares might not be the thing for you, and you might need to sit down with someone like me or other advisors elsewhere that would teach you that would tell you the difference between what risk are you exposed to when you're buying shares, and risk you're exposed to when you're buying ETFs. The difference in trading costs. As I was saying, one of the value adds that you get from an ETF, from a passive product, is their costing. There's an average TR ratio of 40 basis points, plus an investment platform that ranges between 45 basis points to 80 basis points, depending on that platform. There's brokerage, very low brokerage of 10 basis points of the investment value. And on shares, you would find that it's more expensive to actually get into trading shares. I don't want to get into the amounts, but if you are coming in as a startup investor, as you're just starting up in investments, maybe ETFs are for you because they're very cheap and you are buying the overall market with a single transaction. On shares, you have to open a trading account. It has a couple of expenses that come with it. There's a custodian fee that comes in a monthly basis. There's brokerage that ranges around 0.5% of each trade. So when you're buying a trade, you will pay 0.5%, and when you're coming out of the trade, when you're selling, you'll pay 0.5 again. As in ETFs, as you can see that on ETFs, it's 0.1% of the investment value. So without no doubt, I would say shares are more expensive than ETFs, because if I'd have to buy the top 40 with a single transaction at 10 basis points and buy 40 shares that come at 0.5 each trade, 0.5% each trade, can be really expensive. So that's kind of the difference between the trading costs. So I've got a great example just to explain this next slide. Each share has a specific risk that is only that has that is exposed to, and is also exposed to market risk. So as you can see from my graph there, that stock-specific risk is, especially with one share, can be very high, and as you're getting more shares, it comes down to at least closer to market risk, which is what market risk is, what an ETF, a top 40 ETF, will give you, because it actually tracks the index. So let me just give you an example of a stock-specific risk. Pinnacle is a great share, one of the darlings of the country. It's one of the technology companies we have. But in sometime this year, it fell over 40% in a couple of days. And that was due to one of the board directors, one of the board members, who was involved in a very scandalous type of allegation. And I mean, that's stock-specific risk, that it actually goes into even the board members, that what they're doing, are they well known? Are they any irregular activities that the board members will do will actually become part of that stock-specific risk. And the market, when Pinnacle fell by about 40%, the market didn't take a big hit, because the overall market is well diversified over a couple of shares. So it's really, you wanna know what you're getting yourself into. You wanna do a lot of research and know what risk you are taking with buying one share or with buying a couple of shares. Let's say a portfolio of 5 shares. You will have that stock-specific risk over someone who's holding the overall market. Go. The next one is just a few. It's just a slide with performance over the past, with an average performance of the past 5 years. As you can see, we have Cetrix Swix, which is the top 40. It has a specific weighting so it's quite different to the normal top 40. We have an RMB top 40, which is exactly the same as a Cetrix top 40. Those will give you on an average of 5 years, about 19.62%, which is RMB, and Cetrix is sitting at 19.76%. So that's exactly what you should, if that's very interesting for you as an investor, if that can make you happy of looking at an average of 5 years, 20%, close to 20%, then that's for you. But some investors really are looking for alpha. They want something better than the market. And I think for most investors, especially if you're just coming into the market, maybe an RMB top 40 for an equity exposure is for you. And one of the most liked ETFs around the market is usually not even the top 40. Some guys just prefer the Cetrix Indy or any industrial fund, any industrial top 40 you'll find, because it has better performed over in an average of 5 years, 5-year period as well. That's me. My name is Aphindile again from Vunani. Yeah, thanks.